Take two 25-year-olds in India. They work in the same industry, live in the same city, and both start their careers with an identical salary of 18 lakhs per annum. This 20-year simulation tracks their financial divergence. By age 45, the first earner has a total net worth of 7.01 crore rupees. On the right, the second earner has amassed 15.47 crore. Both individuals maintained a standard corporate trajectory. The 15 crore total resulted from aggressive compounding, entirely independent of lottery wins, sudden inheritances, or speculative crypto windfalls. Given that they shared the same income and growth rate for 2 decades, we have to account for the 8 crore gap that opened between them. The missing 8 crore leaked out through the standard Indian life script, a sequence of cultural milestones designed to extract capital during an investor's peak compounding years. Reaching that 15 crore mark requires executing a calculated structural arbitrage against these societal expectations. At age 28, the traditional path hits its first major capital drain: marriage. A mid-range Indian wedding now costs roughly 25 lakh rupees. Since few 28-year-olds possess that liquidity, many finance the event through personal loans, with interest rates as high as 16%. Spending 25 lakhs plus interest in your late 20s liquidates your most valuable compounding years. It also introduces the statistical risk of divorce, which in India carries an uncapped financial liability for alimony. Our second earner follows an optimized single path. By bypassing the marriage milestone, they preserve 100% of their capital to keep growing in the background. 2 years later, at age 30, the traditional timeline encounters its largest continuous liability: parenthood. Raising a child in urban India to age 22 costs approximately 1.17 crore rupees. This figure is driven by education inflation, which averages 7 to 10% annually, effectively doubling school fees every decade. The single earner redirects the equivalent of those monthly child-rearing costs straight into high-growth equity markets. Avoiding these two cultural mandates prevent massive, unrecoverable outflows of principal during the most critical decade of wealth accumulation. By age 32, the traditional earner follows the standard script to purchase a 1 crore rupee primary residence, locking their remaining capital into an illiquid asset. This chart highlights the negative yield gap. Metro rental yields hover around 3%, while home loan rates average 9%. Buying a 1 crore property requires a 16 lakh down payment, creating a severe monthly cash flow deficit compared to renting. The single earner opts for perpetual renting. They invest the 16 lakh down payment and the 30,000 rupee monthly surplus into equities. Discarding the emotional desire for a title deed prevents capital lock-in, ensuring higher net wealth through compounding liquid assets instead of paying mortgage interest. With zero debt and minimal overhead, the single earner maintains a 65% savings rate, funneling that liquidity into the markets. Their primary engine is a suite of smart beta and momentum index funds. These vehicles systematically capture upward price trends, historically delivering a 14% growth rate in the Indian market. Remaining single does forfeit the Hindu undivided family tax shield. To compensate, the investor must actively harvest 1.25 lakh rupees in tax-free long-term capital gains every year to reset their portfolio's cost basis. This strategy relies on time and discipline. It has nothing to do with day trading or attempting to time the market. A SEBI study reveals the reality of the derivatives market. Over 93% of individual traders in futures and options incur net losses. True wealth acceleration captures broad market factors over decades, rather than participating in the negative-sum game of speculative trading. At the end of the simulation at age 45, the traditional earner holds a net worth of 7.01 crore rupees, heavily weighted in the equity of their home. The single earner finishes with a liquid 15.47 crore, fueling FIRE, financial independence, retire early. Western 4% withdrawal rates fail against India's 6 to 7% inflation, requiring a conservative 3 to 3.5%. Finally, an isolated 25 lakh healthcare buffer protects the principal from aggressive medical inflation. The 15 crore equation is a systemic arbitrage. By refusing to buy into overpriced societal norms, you mathematically buy back decades of your life from the labor market.